All right. Is that even playing? I can't hear the music or not. I don't even know if it's playing. There it goes. There it. A little technical problem. Good morning, all you magnificent melon heads, and happy Tuesday, everybody. We're starting a day with tech issues on my intro music, but today is April 23rd, 2024, and the top story today is UPS earnings. And really, with all the earnings we're going to talk about today, all the stories we're going to talk about here, you're going to see inflation and you are going to see margins getting squeezed. You're going to see things like shrinkflation. It's playing out across every single one of these stories consistently, starting with UPS. UPS reported earnings today, and there's a couple of really important numbers in here. Average daily volumes, the number of packages that are getting shipped around the world, down 3.2% domestically, and then down 5.8% international. So UPS is moving less stuff, fewer boxes on the trucks, big brown, whatever you want to say. There's just less stuff going around. At the same time, their operating margins have been crushed. Remember last year, all the talk, especially late last fall, late last summer, that time frame, there was a lot of threat of the UPS strike. The Teamsters were threatening to go on strike. All the UPS drivers were threatening. All the airlines were going through the same thing. Well, the UPS drivers got themselves a great big raise. Same thing with all the people that worked at the terminals. Big raises across the board for UPS employees. And well, now we're starting to see the downside to that. Operating margins were just 8% for UPS this quarter. Last year, the same quarter, operating margins were 11.1%. So we're looking at almost a 30% decline in the operating margins for UPS because of those higher salaries and those lower volumes. So inflation, people can afford to buy less stuff, fewer boxes on the trucks, and people are demanding a higher wage because the cost of living has gone up so much. And well, that means UPS earnings are getting clobbered. Profits are down 35% year over year for the first quarter for UPS. All right. Tell me it's the best economy ever. Tell me again how wonderful this economy is when UPS, the company that moves stuff around in this economy, is seeing earnings drop by more than a third. That is the state of things. And, UPS is trying to offset this big decline. They're trying to, compensate for the higher wage pressures by cutting people off, by cutting jobs. 12,000 layoffs were announced back in January. They're trying to save $1 billion this year. Well, that's not working yet because those layoffs, I don't know how many of them have actually been implemented, but it is yet to improve the margins at all at UPS. Also, we got GM earnings today. GM's earnings were great. If you stop reading at the headline, profits up 24% year over year. The auto industry could use some good news. We've been talking all about how hours are getting cut at the factories. The EV bubble, forget it. Electric vehicles have just been absolutely a bloodbath. We'll get more on that this afternoon when Tesla reports earnings. Look out for that one. But GM reported pretty good numbers today. 24% increase year over year in profits. Stop reading right there. Everything is great. But when you actually look, vehicle production, the actual number of vehicles delivered was actually down versus a year ago, down by 35,000. So they actually shipped 2.5% fewer vehicles. So how are profits up 24% if they delivered 2.5% fewer vehicles? Inflation. The price of those vehicles has risen so much that they can sell fewer cars and make a whole lot more money. Also notable is the mix. What cars are they selling? They're selling big SUVs and they're selling big pickup trucks. All the vehicles that the people in charge are trying to ban. All the big cars and trucks that everybody's saying, oh, they're no good. They're polluters. You can't have those anymore. You need to ride to work on high-speed electric roller skates instead. Well, people are speaking. They're voting their wallets. Americans like big trucks. We like big vehicles. We like gas guzzlers. We're imperfect beings. So be it. You try to force us to buy these electric vehicles, subsidize the hell out of the industry, and, well, we're watching in real time what that results in. People are still buying the big trucks. They're not buying the EVs. The taxpayers are getting fleeced. The guys who own these companies are making out like bandits, and the cars are just stacking up at the dealer lots and stacking up at the factories. Also, we got today news out of Apple. More news about iPhone sales, about demand for iPhones in China shrinking. This time we got yet another report from another analytics agency saying that iPhone sales volume in China dropped by 19% in the first quarter. Big drop in iPhone demand. And interestingly enough, it was just yesterday we were talking about Verizon earnings and how phone upgrades at Verizon were down big, down by 18.5%. It's an oddly similar number, isn't it? Fewer fewer upgrades at Verizon. That wasn't just iPhones. That was just upgrades of any phones, which includes Android, obviously. But an 18.5% decline in upgrades for Verizon. And now we're seeing a 19% decline in iPhone demand in China. Now, interestingly enough, they're not saying this is due to any kind of a shrink in the market. The market for smartphones in China is still growing, albeit at a much lower clip than historically. But it really comes down to Huawei. Huawei is eating Apple's lunch in China right now. And, well, Apple reports, I believe, late next week. And with big numbers, big declines like that in China, it can't be good things for Apple, especially not in the context of the numbers we got from Verizon that said, hey, fewer people are upgrading here in the States. Fewer people are buying iPhones in China. I think we got some bad numbers from Apple coming up in these next few weeks here. And we got Pepsi this morning also. Now, stop me if you've heard this one. Revenue up 2%. Let's see. Net pricing up 5%. Volume down 2%. So what do these numbers mean as a whole? One, Pepsi's making a little bit more money thanks inflation. They raised their prices by 5%, so still higher than the rate of inflation. So either the inflation rate they're telling us is artificially low, or Pepsi's just growing their profit margins. Maybe a little bit of that greedflation I hear so much about in Bloomberg. Yeah, like greed was just invented in 2022. But the volume's down 2%. That's interesting. Prices rose by 5%, volume shrank by 2%. All right, so Pepsi has a little bit of pricing power left, emphasis a little, but they're almost gone now because as they raise prices, they're selling less stuff, which means they can't continue to pass those costs on to the consumer. Maybe that means there's a decline in inflation on the horizon at some point because Pepsi, we've seen it. They raised their prices 5% and they sold less stuff. Now, the 2% shrink didn't match the 5% increase in prices, so Pepsi still made more money. So they're still incentivized to raise prices, but there's a diminishing return as they continue to do that. Also noteworthy in Pepsi's earnings, they've mentioned a lot about smaller packages, reduced portions, i.e. shrinkflation. We've all seen those pictures of the bag of chips from a year ago and then the bag of chips from this year. And, well, there's a lot less chips in the bag than there was a year ago. And last but not least, another story, one you don't hear about too often, a company called Randstad. They're a recruiting firm. They're based in Europe, but they do a lot of business here in the U.S. They're a recruiting firm and a temp agency. And they reported earnings today, 33% decline in earnings for Randstad. Their revenue shrank by 8% globally, but their revenue in North America shrank by 15%. So they saw double the declines in North America than they saw elsewhere. That's important because Randstad has a couple of specialties. They specialize in areas like tech, financial services, life sciences, biotech, medical. And their revenues in North America are down 15%. That's a recruiting company. That's a temp agency. When their earnings are down big, that's telling you that the job market is in trouble. And we've been saying it for well over a year and a half now. The job market in America is not anywhere near as strong as they're advertising. We're losing those good white-collar, high-paying jobs like tech, finance, and life services. And we're getting part-time garbage jobs in retail and food service and leisure and hospitality. And people are having to get 2 of those jobs just to offset the one white-collar job that they lost. And meanwhile, the politicians are saying, look at all the jobs I've added. Well, Randstad's earnings tells us the job market is not anywhere near as strong as they're telling us. So look at all these stories in aggregate: higher inflation, shrinking portions, shrinking package volumes for UPS, smaller packages for PepsiCo, GM charging more for fewer cars, and Randstad hiring fewer people. It's the best economy ever, isn't it? Maybe we should just shrink my big melon of a head and let's see what's going on in the markets this morning. And guys, don't forget that like button while we're at it. And if you're new here, hit that subscribe button right next to it and that notification bell so you can have the coffee with the melon heads every day, because we do this stream every morning. And right now, the S&P 500 is up 21 points ahead of the opening bell, or 0.42% higher. The Dow is up 127 points ahead of the open, about 1/3 of 1% higher this morning. And the NASDAQ is leading the way higher, up almost 0.5%, 80 points higher for the NASDAQ. That's after a pretty good day for stocks yesterday as well. We have got a dollar that's a little bit lower here this morning, 106.01. We had dipped below that all-important 106 level for a while there this morning, but back above it now, currently down 7 basis points. And looking over at the bond market, once again, yields are higher across the board. 30-year Treasury, 4.748. That's up 2.5 points. The 10 years at 4.645, also up 2 points and change. The 2 years at 4.987, up 1.5. And the 1 month Treasury, 5.400. That's up 2 basis points this morning. Even the 1 month is moving a little bit higher here. Remember, guys, when you see interest rates rising, that's bond prices falling. So people are selling bonds this morning. And looking over at commodities, the bloodbath in commodities continues. It started yesterday. We had that big old price smash in gold and silver. Not quite as bad today, but continuing nonetheless. We've got June gold futures at $2,325. That's down $20.15 this morning, or about 0.86% lower. May silver futures at $27.11. That's down another 13 cents, or about 0.5% lower. That's on top of yesterday's 5% decline in silver. The precious metals just got crushed yesterday. Platinum is down 1.75%. Palladium's down 1.25%. And crude oil, West Texas Intermediate June futures, $81.40. That's down another 50 cents this morning, or 0.62%. Let's look at Bitcoin here. We've got Bitcoin is down $700 this morning, trading at $66,150. Had a pretty good day yesterday, recovered a little bit, but if we zoom in here, it looks like a little bit of resistance right at the 50-day moving average. And that place is ceiling around 67,500. We'll see if that level holds today. And also, here's taking a look at the silver chart so you can get an idea of just how violent that price smash was yesterday. Look at that big red candle down yesterday, continuing this morning, although we're well off our lows. So there's that 28.30 level, guys. If we zoom out all the way back to the silver squeeze, you can see that level. They defended it last time and it held. They defended it several times and it held every time. And, well, we made another run at it, and yesterday we broke down. So is that the end of this story? Probably not. But for now, Mr. Slammy has won the battle for $28.30 once again. Now let's talk about the big story this morning. UPS profit beats estimates as cost cuts offset weak delivery demand. Again, it's the best economy ever. Cost cuts, weak delivery demand. What? That one of these things doesn't fit the narrative, but okay. United Parcel Service reported first quarter profit above estimates on Tuesday as cost cuts partly offset subdued demand for small package deliveries, sending its shares up 3.5% pre-market. The company had cut 12,000 jobs in January to save $1 billion in costs in 2024, attempting to counter sagging volumes and higher labor expenses as demand normalized following a boom during the pandemic. UPS reported a 3.2% decline in average daily volume in its domestic segment and a 5.8% drop in its international segment, but said volumes had shown improvement through the quarter. I don't know how you're going to say they were down 3.2%, but they showed improvement. I guess they were down more at the beginning of the quarter than they are at the end of the quarter. They're just trying to paint this as rosy as they possibly can. Let's see. What else do we have here? Revenue in both major businesses, U.S. domestic and international, fell short of expectations, said Jonathan Campbell. A new contract with the Teamsters Union has also been squeezing the Atlanta-based company's margins. UPS is absorbing 46% of the wage and benefit costs of the new 5-year contract in 2024. It reported a net operating margin of 8% for the quarter. That's down from 11.1% last year. So their margins are getting squeezed here. Fewer packages, paying more to move them because of those big increases in wages. That's shown in almost a third drop in their profit margins. The company said earlier that this quarter's margin would be its lowest in 2024, with business conditions improving in the second half of the year. And, well, here we go. This is the world's biggest package delivery firm by market cap, posted an adjusted profit of $1.43 per share for the quarter. That is down 35% from last year, but above estimates for $1.29, according to LSEG data. So only in this market can you report a 35% decline in profits and the headline beats expectations. And UPS stock this morning down about 0.8% ahead of the opening bell, trading at $144.16. That is $1.20 lower. And we got more news out of GM this morning. GM raises profit outlook for 2024 after strong first quarter earnings. Pickup trucks and resilient consumer spending powered a 24% increase in quarterly profit. But China remains a trouble spot. Now, that's a little bit misleading, resilient consumer spending, because they're selling fewer cars. They're actually delivering a little bit fewer cars than they did a year ago. But it's those much higher prices that are really driving all that big beat, that big increase in their earnings. General Motors lifted its profit outlook for the year as the automaker leans into strong demand for gas-powered trucks and sport utility vehicles while trimming investments in future bets such as robo-taxis. The Detroit-based car company on Tuesday reported a 24% rise in first quarter profits, driven by solid U.S. sales of pickup trucks, the company's biggest moneymaker. The strength in GM's home market helped offset considerable weakness overseas, including a rare loss in China, long a profit center for the company. Now, that's interesting, losses in China, because here we can see China remains a trouble spot. GM lost $106 million for the quarter in the world's largest car market by sales. So not only did they not make any money, they lost $106 million doing business in China. GM and other global automakers have been losing market share for years in China, hurt by the rise of Chinese-branded electric vehicles. And GM's earnings also were hurt by a decline in vehicle production elsewhere in Asia, as well as in South America, its third largest market. And, I just want to say thank you very much to Frog Capital, once again, who is making the stream this morning. Check out @Frog News on X. And he posted this one. This is right out of GM's earnings release today. And you can see here, this is their first quarter of 2024 in thousands, the number of vehicles delivered in their various regions. And then here's the first quarter of 2023. And you can see overall 1.347 million vehicles were delivered in this quarter versus a year ago, 1.382 million vehicles were delivered. So GM, we're looking at, what do we got? A 2.5% decline in the number of vehicles sold, but a 24% year-over-year increase in profits. Why? Because of inflation, because they rose the price of those vehicles. And you'll notice, guys, that this decline is across the board in virtually every region. They shipped fewer vehicles than they did a year ago. The U.S. being the one exception. They actually shipped 2,000 more cars in North America versus a year ago, although the U.S. was actually lower. So I guess Canada or Mexico, somebody's buying cars in Canada and Mexico. So good luck with that one, GM. General Motors stock this morning, however, is up 5.76%, 2.5% higher. So market is really liking those big fat profit margins. As long as people keep buying these cars, despite the higher prices, despite the higher interest rates, GM stock looking pretty good here. We'll see if that one lasts. Also this morning, we got more troubling data for Apple. We've seen this one for quite a while here. Apple iPhone sales tumbled in China in the first quarter, a research firm says. We've seen a couple of stories like this, a lot of warnings about iPhone demand in China over these last few months. We got another one this morning. This is just dated April 23rd, came out at 5:20 a.m. Eastern time. Apple iPhone sales tumbled in China during the first quarter, a research firm said on Tuesday. This is a research firm called Counterpoint, reported that iPhone sales volume dropped 19% during the quarter, in which smartphone sales in the world's second largest economy actually grew by 1.5%. So this is not a market-wide slowdown in phone sales. This is just a slowdown in iPhone sales, down 19%, while the overall market grew 1.5%. This is a very bad indicator for Apple here. The 19% decline is actually an improvement of sorts on the estimated 24% decline for iPhone sales that Counterpoint estimated in the first 6 weeks of the year. Huawei's phone sales have surged 70% in the first quarter, helped by the launch of the 5G-capable Mate 60 series. The Counterpoint report said Huawei sales impacted Apple in the premium segment, and also that replacement demand for Apple has been subdued compared to previous years. So that's the reason right there. It is Huawei in their 70% surge in sales. Apple is losing market share to the domestic brand Huawei over in China, and it's not just a small loss of market share. They are getting clobbered, down 19%, while Huawei sales are surging 70%. For the second quarter, the possibility of new color options combined with aggressive sales initiatives could bring the brand back into positive territory, talking about Apple here. And of course, we're waiting to see what its AI features will offer come in June, said Ivan Lamb, a senior research analyst at Counterpoint. And that paragraph right there just goes to show you just how far Apple has fallen from grace. They're getting their lunch eaten by Huawei. I mean, Huawei is gaining double-digit market share. Apple is losing it. And meanwhile, they're saying, hey, we've got new colors coming out. When's the last time you bought an iPhone because of the color? Oh, yeah, I really want that pink iPhone. It's got 4 cameras instead of 3. Apple has not innovated. There hasn't been anything exciting in the phone space from Apple in almost 10 years now? I mean, they've come out with these different emojis, different cameras, a front-facing camera, 3 forward-facing cameras. They haven't innovated, and it's starting to hurt them. And now they're sitting here saying, well, we hope the new color iPhones will really juice sales. If that's the only hope you have for turning things around, then there's nothing good on the horizon for you. And then, of course, they're saying we're waiting to see what their AI features will be. Apple was pretty late to the AI game. They didn't even start making any announcements about big investments in AI until well into the mania, just because they had to at that point, because everybody was afraid of not making investments in AI. So I don't know that some new smart Siri is going to come turn things around for iPhone either. Apple stock, though, holding up pretty well this morning, down just 20 cents or 0.12%, although year-to-date, Apple has had a pretty rough year. Started the year around $185, now at $165. And also going on this morning, we got earnings from Pepsi. More of the same, more of that inflation, more of that shrinkflation. This is in usnews.com. PepsiCo beats Q1 revenue forecast as price increases moderate. Still seeing prices go up. They're just going up a little slower. PepsiCo reported better than expected revenue in the first quarter on strong international demand for its snacks and beverages. PepsiCo reported better than expected revenue in the first quarter on strong international demand. The New York-based company said revenue rose 2% to $18.3 billion for the January to April period. That was higher than the $18 billion that Wall Street forecast, according to analysts polled by FactSet. PepsiCo has leaned heavily into price increases over the past 2 years to combat higher ingredient costs. The fourth quarter of 2023 was the company's 8th straight quarter of double-digit price increases. 8 consecutive quarters of double digits. Read that one again, guys, because I feel like some of you maybe didn't take the walk with me. Keep in mind, we are told inflation peaked at 9% a year ago, and that it's been low single digits ever since. It's been falling. And yet we've got 2 years, 8 consecutive quarters of double-digit price increases from PepsiCo. And keep in mind, guys, this includes Frito-Lay, Quaker Oats, right? These guys make everything. 2 years in a row, double-digit price increases while they tell us inflation is approaching their 2% target. You got to love those government statistics. But those increases moderated in the first quarter. Well, there's that. PepsiCo said net pricing was up 5% globally during the quarter, while volumes fell 2%. PepsiCo has said some of that volume decline is strategic. The company has been shrinking package sizes to meet consumer demand for convenience and portion control. Yeah, convenience. That's what they've been doing it. And portion control. Because Pepsi really cares about how fat we're getting, right? All of a sudden, they grow conscious. PepsiCo said its net earnings rose 5.6% to $2 billion in the first quarter. Excluding special items, the company earned $1.61 per share. Now, the important thing here, guys, pricing up 5% globally. Volumes fell 2%. So as they raise prices, they are losing sales. People are buying less stuff because of those price increases. Although the decline in volumes is less than the increase in prices, so Pepsi still has room to raise prices further. So it looks like those prices are going to keep going up for the time being, although we should see that start to slow here. But after 2 consecutive years, 8 consecutive quarters of double-digit price increases, you'll forgive me if I don't get too excited about the prospect of low single-digit price increases at Pepsi, especially while they're shrinking the size of packages. And they're saying, yeah, it's for convenience and portion control. No, it's not. It's for profit margins. They don't care about your convenience, and they don't care about your cholesterol. They don't care about your BMI. Trust me, it's about profit margins. Shrinkflation is alive and well at the Pepsi company, and their stock is doing all right this morning, up 1/3%, 54 cents higher, trading at $177 ahead of the opening bell here. And the last one of the day, Dutch recruiter Randstad lags profit forecast in a tough hiring market. This one's kind of obscure. It's not a company a lot of people follow that closely, but this is all about the strength of the labor market, especially you real estate guys, you prospective home buyers. It's the job market that's going to dictate what housing prices do. And, well, take a listen to this one here. Randstad reported a bigger than expected drop in first quarter earnings on Tuesday, sending shares in the world's biggest employment agency down about 6%. Recruiters have been flagging tough hiring conditions in recent quarters as workers prefer to avoid the risk of switching jobs, and employers offer smaller salary hikes amid market uncertainty. Does that sound like a strong job market to you? Does that sound like a booming labor market where people are afraid to switch jobs, where employers offer smaller salary hikes? That's not a strong jobs market. The Dutch group reported a 33% fall in quarterly earnings before interest, taxes, and amortization to 177 million euros, below the 181 million euros analysts had expected. High double-digit decline in earnings for the world's biggest recruiting firm. Yeah, it's the best economy ever. It's the strongest jobs market ever. And that's why the company that hires people for a living is losing money. You gotta love this stuff, guys. Now, what they're particularly talking about here is North America. This is a European company, but this is not a European problem. This is actually a North American problem. Randstad's revenue fell 8% organically to 5.94 billion euros in the first quarter, but it reported a 15% revenue drop in North America. So double the global average. The drop in revenues in North America was double the drop seen elsewhere in the world. That is the weakest among all its geographies. North America, which is about half of Randstad's digital business, has been under pressure, the CEO said. The region is focused on technology, financial services, and life sciences, all high-paying jobs, which have not been hiring as many people, he added. And there is your white-collar recession right there, the firm that hires high-end workers for tech, for finance, for life sciences. They're not hiring people. Why? Because all the jobs are going to freaking Starbucks. That's why. Part-time jobs replacing full-time jobs. You can see it in Randstad's numbers, a 33% drop in earnings for this quarter, where earnings in North America, revenue in North America was down double the global average. There is your strong jobs market right there, folks. And I just want to say thank you very much to Kimberly Z, who says, thank you for the valuable content. Appreciate it. Well, thank you very much, Kimberly. I appreciate the kind words and the support of the channel. And you are most welcome. Thank you for having your coffee with the Melon Heads this morning. And thank you to Cole Marsh, who says, coffee time, stay frosty, my friend. Was that a most interesting man in the world reference? Stay thirsty, my friends. Thank you, Cole Marsh. I appreciate the super chat, sir, the support of the channel. And thank you for having your coffee with the Melon Heads. And my man, Steve Woitis. What's going on, Steve? He says, we have a cottage we rent out in the summer. Last 5 years, available rental weeks fill within days. This year took 6 weeks to fill. Soft market. All right, so that's interesting. There's two ways you could look at this, Steve, right? It's taking longer to fill, so the market is trending in the wrong direction, right? If it was full within days, now 6 weeks. I'm assuming you didn't lower your prices there. I'm assuming a constant price level. That shows a big decline in demand there. However, I would point out that you still filled it. You don't have vacancies yet, so still a little bit of strength in that market. Not as strong as we've seen in prior years, but it looks like this is a summer rental. I'm assuming this is a little bit of a tourist destination here. So the travel industry, not as strong as a year ago, but still doing okay. You're still managing to fill it. So a couple of different ways you could look at it. And Steve is saying, yes, it was a constant price. I did catch that one in the chat. Thank you for clarifying that, Steve. So all things considered, could be a lot worse. It could be a lot worse. Definitely a decline showing there. So keep an eye on that one. And I see right before I was about to sign off, Learcy, I have a lot of trouble with your last name, so I'm just going to call it Learcy. Learcy says, when will all the crappy jobs run out? Thanks, Jack. Well, you're welcome. Crappy jobs, I think, are probably going to start running out. Look, think about some of the stories we saw over the last few days. We saw Red Lobster filing for Chapter 11. We saw Express filing for Chapter 11, right? Now, Red Lobster and Express, not really barometers of the economy. They're just, anecdata points, if you will. But those are predominantly part-time workers. Also, all the dollar stores that are shutting down. Predominantly part-time workers. Thousands of those jobs going away as retail gets hurt, as travel slows. Case in point, Steve's cottage renting out, taking longer to rent out. So I think we're probably already starting to see a little bit of a decline in those part-time jobs. Now, keep in mind, as we're seeing those stories of layoffs, and these companies going out of business and shutting down stores, there are still other companies that are hiring. So it's not like we're going to see an instant decline in part-time jobs. But I do think, number one, the decline in full-time jobs is going to continue. And even if we still see hiring in part-time, the hiring in part-time won't be as frenzied as it has been. And so I think we're probably not too far off here. Again, it's an election year, so are we going to get any negative numbers? Not when you can just downwardly revise later. I mean, the jobs numbers have been so grotesquely manipulated over the last year and a half. Are we going to see the crappy jobs run out? They may have run out already, Learsey, and they just won't show it until after we vote. I wish it wasn't like that. I wish we had better data points to go off of, because these are important decisions that are being made on flawed data, but you got to play the hand you're dealt, and this is the data we have. So my gut tells me we're not going to see a negative jobs print until after the election, unless there's something massive breaks in the market, and we just haven't seen anything massive break in the market yet. We came close last March. Fed turned on the money printer, the Bank Term Funding Program, increased the money supply, and stopped it dead in its tracks. If they hadn't done that, if they hadn't rescued the banks last year, we probably already would have seen that. Instead, they chose monetary debasement. And instead of sitting here talking about the recession we're in, we're sitting here talking about inflation coming back. Well, they made that decision last March when they bailed out the banks, and now we all get to enjoy that. So when my gut tells me not until after the election. And then I think after the election, that's going to be like when some guy pulls the cord on the life raft and the whole thing just goes, just explodes out of there. And everyone says, oh, wow, it's amazing. It all must have happened just right after the election. Certainly no manipulation of the data going on there, right? All right. Thank you very much, Learsey. I appreciate the super chat, the support of the channel, and thank you for being a Melonhead member for 2 months. I appreciate that very much. And thank you, everybody, for having your coffee with the Melonheads this morning. I appreciate you guys. Have an awesome, awesome day. Thank you to all my channel members and magnanimous Melonheads and my Patreon supporters. I got links down below to all that good stuff, should you feel so inclined. Hi, Mom. Hi, Dad. Love you guys. Everybody, till next time, live small and dream big.